I thank all my speakers. Before we go into the cocktail hour, I would like to continue a little bit with our questions that we received from you. The first one that I would like to address is to Stuart. You had a little break, so I thought it's fair. Stuart, do you think that Canada should try to break free from its reliance on the US economy? And if so, what country might be a good partner?
Yeah, absolutely. We have been hammering for many years, our shop in particular, on what we call the diversification dividend. And clearly, you know, country goes into crisis, US goes into recession, and suddenly it's sort of impetus for Canadian businesses to start looking beyond the United States. So in many ways, you know, necessity is the mother, we like to say necessity is the mother of invention, crisis is the mother of transformation. And as a result of the downturn in the US, we started to see a pickup in diversification away from US markets. Unfortunately, to some extent, that's reversed in the last little while because opportunities have returned to the United States, and it's just so easy for Canadian businesses to do business in the US. But you know, we look at things like the fact that Canada's trade, 12% of our exports go to the emerging markets. The emerging markets are 57% of the global economy, and only 12% of our exports go there. If you look at Brazil, Russia, India, China, Mexico, Indonesia, that's half the world's population. Those countries account for 6% of our total exports, which, you know, going forward is just not a sustainable, it's not a sustainable platform. So in particular for us, what we are really pushing is the emerging markets in general. I frankly think that this is a great time to be moving into the emerging markets. Again, it depends where you're going and what you're looking for. EDC has the luxury of being what we call patient capital, and so we have the ability to be have that longer term outlook. But we look at the Brazils, for example, and we see Brazil was a hyper-competitive market not a few years ago. Impossible for a small business to get into their sector in Brazil. Suddenly, there are opportunities in Brazil when others are exiting the market. You know, from EDC's perspective, why not approach the market when capital's fleeing the market? There are good opportunities for us there. Again, you need to know what you're looking for, and you need to partner with the right partner. But the emerging markets to us offer such enormous opportunities over the longer term. China is another big one for us. I agree with what Wynn said. You know, I just don't see this hard landing in China. It drives me crazy when people talk about, you know, China slowdown. I mean, China even at the 13th five-year plan is talking about Chinese growth between 6 and 7%. We have growth right in the middle at 6.5%. Even if China were to grow at 5%, the additional value it adds to its economy is equivalent to 18% growth in the 2004 to 2008 period. So, you know, people were kind of wringing their hands when Chinese growth fell to 7.1% in 2014. At 7.1% growth in 2014, just the growth alone would have qualified for a seat on the G20. The growth alone in China was bigger than Turkey's entire economy. So, you know, there's a famous Wall Street analyst that likes to say at 5%, China adds a new Italy to its economy every 5 or 6 months. So you need to understand what that means in terms of the sheer magnitude of the economy, and that's what creates demand for services and for goods and for commodities. So yeah, we look at the emerging markets and we see big opportunities in the emerging markets these days, provided you approach with, you know, some caution.
Thank you very much. You also answered a question about China that we had received. So let us move to Brazil. Maybe the two of you can share your opinions, or you might want to chime in then. Let me read it to you. How is it that Brazil has gone from the most promising of the BRICS to the broken? And is it going to get better?
So it's for me?
I'll have Dan start,
Yes,
and then we'll do the tour de table.
Well, I fall in the camp that I don't even know why Brazil was ever a BRIC to begin with. Because when Brazil became a BRIC, it was heavily indebted, it just came off a military government, and frankly, its growth on a long-term basis has never justified being in the BRIC category. It basically has not been able to sustain more than about a 2 to 3% growth rate forever. So people got all excited about it. If you look at it from that perspective, it really should be no surprise to anyone that Brazil has not done well. It might be a surprise that it has fallen as far and as fast as it has. But if you think about all of the forces at play, right? The corruption, the global turndown, et cetera, how much Brazil hitched its wagon to the Chinese economy, then it all makes a little bit more sense.
Thank you. Do you want to add something?
Sure.
To it, Stuart?
Brazil tends to be one of these countries that just follows, and I think Wynn said that it just follows the cycle, the commodity price cycle. It's always kind of the next big economy, and then commodity prices fall, and it falls into rough times. I'm not a big fan of these acronyms that carry all this implied value with it. The BRIC economies or the BRIC M's, or I think ultimately you look at an economy, you look at a market, you look at its fundamentals, you look specifically at the sector you're interested in, and you decide whether there is value, whether there's opportunity there for you or not. I think, frankly, for many in many sectors, Brazil still does have huge amounts of potential. It's got vast amount of natural resources. It's got a big population that has the potential to emerge into the consuming middle class. Vast territory that needs to be connected through infrastructure networks, and so big opportunities there, for example, for infrastructure companies. So I think you really need to be more specific rather than these labels of the BRICS. I find that it doesn't really do a service to businesses that are trying to figure things out.
Yeah, you mentioned some investment potential, especially the infrastructure, which really needs some improvement. A lot of development, we're not talking about improvement, we're talking about development.
Absolutely, and now's the time that's great to move in because of the crisis and because of the scandals. A lot of companies have pulled out from infrastructure in particular. So you need to know who to partner with there, but there's enormous potential in a market like Brazil.
Julian, I saw you nodding, so I guess you agree too.
Yeah, I quite agree. It's true that, at the moment, the key risk is, of course, it's not surprising, but it's related to what's going on the political side. Yeah. But if we try to distinguish and to put aside one moment what's going on the political side, it's true that on a pure economic side, the worst could have been passed. Because, in all emerging market crises, at one point when the currency has crashed, when production has declined a lot, at one point it means that at least it's a boost in terms of competitiveness and so on. And this is what we could see in Brazil. In the early 2000 years, we saw a transfer of capital from manufacturing sectors to the commodity one because commodity prices were going up, and so it attracted a lot of investors. And the outcome was the currency appreciated, and it was negative news from the manufacturing sectors and so on. Now we could see in the coming years exactly the opposite. The currency has crashed, so it means that in terms of competitiveness, it's a pretty good news for the manufacturing sector, and the commodity sectors is less and less attracting. So the only one problem is that to start this positive cycle, we have to end the political crisis. So I don't think we can see some positive news as long as there is this political mess. But as soon as it ends, of course, it will do better.
Thank you. Let's stay a little bit on these countries. It's always the big question. Yes, we can discuss, does it make sense to put some countries together and name them the BRICS, the future, and so on, and promote them. But let's just leave it alone, this discussion. Who or what other countries could be able to become the new engine of our global economy? Do you want to start, Julian? Do you want to take the lead on that?
Sure. It wasn't really a question, right? No, I'm joking. No, at the moment, if you look at it in the very short term, the region in the emerging world, which is almost immune from what's going on the commodity side, from what's going on in China, is Central and Eastern Europe. And this is a region which used to suffer a lot from the pretty bad situation in Europe, and now it's improving. Their domestic market is also quite in a good shape. So all in all, I'm not talking about countries having 6 to 7% growth a year, but I'm talking about countries with quite sound fundamentals in terms of current account, in terms of public debt, and with a growth at 3 to 4% a year. Beyond this, of course, the situation is still quite problematic and quite tricky in most Latin American countries. But we still see some positive trend in some African countries, especially in the eastern part of the continent. Also in Côte d'Ivoire, the potential is there. And of course, we are still quite positive on some Asian countries. Not all of them, but in some Asian countries like the Philippines, for example, or Vietnam.
Yeah.
Yeah, the only thing I would add is it's, sort of conspicuous by its absence that we hadn't mentioned India. I mean, I think India is, you talk about potential drivers of growth. So, to me, the big ones, China, India, but even current opportunities, huge opportunities in India. And of the so-called BRIC economies, it seems to be, to some extent, the standout. But, I'll go back to what I said earlier. I think it really depends on the market that you're looking at, the sector, the particular sector that you're looking at. Emerging markets in general for us carry huge amount of potential. I would start with looking at countries that are getting hammered these days, like a Brazil, to name a few others as well. There are a number of them that I think companies really need to take a serious look at. And again, know where to look and look for the right things, but there are big opportunities now for companies.
Could I just add?
Yes,
I think part of the untold story here is the emerging middle class that's global in nature. You know that the middle class in China soon will be as large as North America and Europe combined, the population. So if you think about the emerging class in the middle class in the emerging world, I think that's where the story is coming in the next 10 to 20 years. And the Indonesias, right, the Indias, these places which are growing, which are democratized, which have natural resources, and have the ability to start to turn things around into a meaningful way. I think that's where the future is.
Very interesting that you mentioned outlook within the next 10 years, and that leads me to a question that is geared towards you. Then, what do you think will be a global economic risk 10 years from now that is not receiving much attention today?
That's a good question. I'm not sure that there will be. I think, the debt question will remain unresolved, yes, and some of the larger questions that we're seeing today will remain unresolved. That's the problem, right? Where is the solution to some of these long-term problems? One of the issues that I think is right around the corner, and I guess if you look at history, you could say that we're certainly due in this country and possibly globally, and these gentlemen being economists will probably be in a better position to answer this, we're due for another recession.
Yeah.
That being the case, we have far fewer tools seemingly in our tool chest to be able to combat them. So one question that I have is, how will we combat these issues, and what are the implications of not being able to adequately address them? I think that will have a knock-on effect to the amount of resources and materials that we might be able to devote to solving some of these other long-term problems.
Yeah. Interesting that you mentioned that. Maybe I can throw in another question that was mentioned from the audience. You said we are due for another recession. So do you think 1 or 2 years from now? What time frame do you anticipate?
Well,
people like specifics.
I'm not the economist on the panel here, so these guys are better qualified. But I will say this. I wrote a piece last year that suggested that the recession is coming this year. It obviously hasn't come in the first half. If it doesn't come in the second half, it's coming next year or sometime soon. Because we are well overdue for this historically, folks.
Yeah.
We don't just keep going up and up and up. And I was at an event this morning where an economist was talking about how superinflated so many asset classes are, and that it's totally unjustified. So it seems like we're repeating history, and we're going back to where we were, and I hope it doesn't end up badly.
We're moving fast, but I would like to go back to that initial question. What risks don't we anticipate that you would think we should look at as well, looking at a time frame of the next 10 years? Is there something you would like to add?
Yeah, I mean, to add to the list, I think there's a pretty good list on the go already, and we've talked a lot about risks already up until this point. But, I'd throw in there disruptive technologies, which is certainly a big risk, water, which we haven't talked about. The debt issue for us is a big one. Japan's debt in particular, we think has the capacity to be extremely disruptive on a global level and with respect to global financial markets. So, I mean, those are some of the big risks that we're looking at over kind of the 5 to 10 year horizon.
Okay, if I have to pick one, I would say debt. It's true that in the news and so on, everybody is used to talk about public debt, and we all know it's a key risk. But I think we underestimate the risk related to corporate debt, both in all parts of the world. For example, and I do this mistake as well. I mean, I've made a 30-minute presentation on Europe, and I've said the situation is improving, and that's true, is improving. But if you look at corporate debt situation in countries like Spain, Portugal, Ireland, and so on, it hasn't improved much. And we underestimate the time it takes to solve this kind of issue. So I think we are going to talk once again about this 10 years from now, and we are going to talk about it for advanced economies and for emerging markets like China, of course.
I would like to cover two more big questions. Maybe we can have a little time to elaborate on them. Of course, everybody's interested in your prediction on the oil price. Who would like to start?
I'm going to leave.
Thanks. No, I'll say that what's really nice about oil prices now, and as I said, for me, I'm not a big fan of point-in-time forecasts. We don't produce point-in-time forecasts, and I think in an environment like this, you would be crazy to do that. And when we don't have we don't have enough information for that type of prediction. What we do is produce these annual average forecasts. What I will say is, for oil, over the short term, what's really nice from a forecasting perspective is we always knew that there was a floor on oil. So the Saudis, for example, wouldn't allow oil to drop below what it needs for its break-even price. So, there was some speculation as to, $20 a barrel. That was kind of the floor that would be set by OPEC, and the Saudis wouldn't allow oil to fall below that floor. What I would say is, while we used to have the floor, we never really had much of a ceiling. And, getting back to the 2008-2011 period, we had people talking about, peak oil and $200 oil. And I believe that with new technologies, with shale oil, this sort of unconventional oil, we now have a bit of a ceiling. The marginal cost of production for shale oil is about $55 a barrel, which means shale oil producers, and truly in shale, in this new form of oil, it's a lot easier to turn production on and off. I mean, it's not quite as simple as flipping a switch, but relatively, you sort of flip the switch and you're able to start producing again without degrading your wells. So, once prices get up to kind of the $50, $55 level, and you've hit your marginal cost of production, you can literally flip the switch and start producing again. So to some extent, over the near term, I believe that provides us a bit of a range between that $20 to $50, $55 mark. I would say longer term, we haven't changed from our longer term fundamental price, which is roughly $70, $75 oil, which we believe, at least now, barring some enormous structural change, is where we see prices in the longer term.
If I could just offer a thought on that. I don't consider myself a pessimist, believe it or not. I consider myself a realist. And if I'm looking forward in the next 1 to 2 years, or maybe even 5 years, I find myself asking the question on this question, what is likely to change? Is consumption likely to change? If anything, it seems to me, if the idea that we're going to enter into a recessionary period comes true, we're likely to have less consumption. And in terms of production, we're likely to continue to have high production, because all those countries that are currently being squeezed, guess what? They're going to continue to be squeezed. And as fractious as OPEC has become, how is Humpty Dumpty going to put itself together again? I don't see that happening either. So I'd love to be proven wrong, but it wouldn't surprise me at all if we stay in this $35 to $50 range for the foreseeable future.
Thank you very much. This leads us to one other region that we have not covered, but we were very bullish about until last year, until the oil price went down. This is Africa. So can you briefly give us an update on Africa, or where you think it'll go? It's now in the reds, we saw that. where do you think it'll go?
It's true that, I mean, obviously this is one of the regions which has been the most impacted by what's going on the commodity side. I mean, 80% of exports are commodity-related one. Having said this, the situation is very different from one country to another, so we can't put them all in the same basket. And if we try to divide countries between, on the one side, those who are really reliant on commodity prices, especially hard commodity prices, because their prices have suffered much than soft commodity ones. And we also put on this part countries which have not made real efforts to diversify their economies, and on the one side, the other one. We can distinguish some countries that are, by the way, benefiting from lower commodity prices, and where we see some signs of economic diversification. So I'm talking about Ethiopia, I'm talking about Kenya, Uganda, and a few minutes ago I was also saying that the situation is pretty good as well in Côte d'Ivoire. So I would say that's the favorite one at the moment. And on the other side of the scale, we see countries like, of course, Angola or Algeria, which are not in the same situation at all.
Thank you. Anyone wants to add anything to that?
I would just add briefly, one of the things we talk about in the book a little bit is the value of entrepreneurialism, and we give some examples about entrepreneurialism in Africa and how in some ways they are leading the way. Do you know, for example, mobile banking is the only way you do banking in Kenya, right? And in some ways, it leads us to believe how far behind we are in the Western world and in the United States. But it seems to me that if Africa is going to be a leader in any way in the world economy in the future, two things have to happen. One is its entrepreneurialism has to be unleashed. And two is that the investment community has to get over itself on Africa, because it remains the region of the world with the far greatest potential for investors.
Thank you. I see you still are patient, so let me finish with the political incorrect question in New York City. It's related to our elections. Globalization is a key component of the world recovery and normalization in commodities market. What would be your scenario if the next president of the US is not in favor of globalization?
I'll take it.
You can have the drink right after.
Yes.
Go ahead.
We're building up to it. I have a piece out in the Huffington Post from a week or two ago that's comparing the likely approach to foreign policy between Clinton and Trump, anticipating, of course, what happened 1 or 2 nights ago in the election in Indiana. My view is this. I don't think that it matters who's in the White House, because the forces of globalization are far stronger than whoever's in the White House. Just like I'm not sure that it matters who's in the White House, because the composition of Congress is far more important than who's in the White House. So I would say it's highly unlikely that anybody would be opposed to globalization sitting in the White House to begin with. I don't think that's really a risk.
Mm-hmm. Interesting. So now I have our guests from other countries speak to it.
Yeah, what I'll say is I think it's a risk in that it's adding to global uncertainty, and it's certainly impacting on these animal spirits that we're talking about inside of the market. So it is a risk, it's there. I would agree that, the next day, whoever wakes up in the White House as President of the United States, regardless of what the rhetoric was on the campaign trail, ultimately has to recognize the realities and will not be in a position to, renegotiate all free trade agreements, as an example, off the top of my head. And I find it, interesting that some of the biggest beneficiaries of globalization tend to be the loudest voices against globalization. So I think that to some extent you can say you're going to take your ball and go home. What that means ultimately is, if you don't want to play the game, your national companies are going to lose out. And I really just don't see that as something that will come to pass, realistic.
No, for sure, this is really concerning. But beyond the specific case of the US, I think the real concern, and perhaps we go back to what I said during my presentation, is that okay, there is Trump in the US, but there are other possible Trumps all around the world. I mean, there's going to be an election in the Philippines next weekend, and the one who is likely to win has also some similar positions. We have Marine Le Pen in France, and this is going to be a huge uncertainty for next year. And you can find a lot of examples all around the world at the moment. So it's true that it's one of the key concerns related to the global economy and globalization. That's true.
Thank you very much. Thank you very much to each of our speakers for coming and spending the afternoon with us. We really appreciate. Thank you, the team of Suhinton, who puts this together for us with a pretty big team. And thank you, everybody, for coming out. You're cordially invited for drinks outside. Don't forget to pick the country risk book. When you leave, it's at the elevators, and we hope to see you next year again. Have a good evening.